Silver's identity crisis might just be the biggest hidden story in markets today, because no one agrees what this metal really is: a pure monetary hedge like gold, or an industrial powerhouse reshaping the future of technology and global growth. You may think silver is just gold's noisy sidekick the cheaper cousin investors grab when fear spikes, but that view is outdated. What's happening in 2026 is not just another price cycle. Silver is undergoing a structural shift, one of the most dramatic transformations in commodities history. For years, traders treated silver as a supplemental precious metal, a poor man's gold. Today, it's morphing into an asset with three co-equal identities: industrial engine, investment hedge, and strategic material. And that's rewriting price dynamics in real time. If you want to understand why silver has swung from historic lows to 18% rebounds and volatile breakouts, you have to go beyond simple charts and look at supply deficits, industrial demand explosion, monetary instability, and evolving macro forces that aren't discussed in headlines. This is where real market behavior emerges and where the true silver narrative lives. Let's break this down the way institutional analysts do, not with speculation but with mechanics, data, and structural demand factors that are actually driving silver's pricing regime. Silver's dual identity didn't happen overnight. Historically, silver was used as both money and industrial input. As early as colonial times, silver coins circulated widely, and during the 19th century's bimetallic standards, silver was literally currency alongside gold. But for decades leading up to the 2020s, silver was largely sidelined as an industrial input relative to metals like copper or aluminum, and as a monetary asset relative to gold. It hovered in the background, with industrial usage and investment demand each sharing pieces but neither dominating. That changed as global markets confronted a confluence of trends in the early to mid-2020s. Renewable energy growth dramatically increased demand, electric vehicle production surged, AI and data center infrastructure expanded. Monetary uncertainty rose because of policy shifts and geopolitical risk. Industrial demand alone now accounts for roughly half of global silver consumption, a structural shift from traditional demand compositions. In 2025, silver's price nearly doubled from early lows, reflecting more than just speculative flows. Underlying demand changed. Solar photovoltaic expansion, EV electrification, and high-tech manufacturing required more silver than supply could comfortably deliver. It wasn't a simple, cyclical spike. It was structural re-anchoring of fundamental demand. This is where silver's identity crisis becomes real. On one hand, silver still carries the characteristics of monetary metal. It is a tangible asset that investors flock to when fiat confidence weakens. In periods of heightened macro risk, monetary pressure, or dollar weakness, silver often rallies alongside gold as a perceived hedge against currency instability. In early 2026, as geopolitical concerns surged following policy shifts, silver rebounded over 18% from recent lows after steep sliding prices, a reaction that reflects not just fear, but repositioning by investors. But here's the twist. Unlike gold, silver's reactions to monetary stress are amplified because its market is smaller, less liquid, and more sensitive to demand imbalances. Silver's volatility isn't a bug, it's a consequence of its dual roles interacting simultaneously. On the other hand, silver's industrial identity has become increasingly powerful. In modern technology, from solar modules, which require silver for conductivity, to battery and control systems in electric vehicles, silver is indispensable. And in sectors tied to AI and high-tech infrastructure, demand is not just rising, it's structurally embedded. That means silver's industrial consumption isn't cyclical, it's secular. Notably, independent research shows the global silver market has been in a structural deficit for multiple years, meaning total demand exceeds total supply. This persistent deficit was not a one-year fluke. Analysts forecast the deficit to continue into 2026, driven by tight physical availability and rising investment and industrial demand. And here lies the heart of the identity crisis. Silver's price behavior is becoming governed by two fundamentally different demand signals that don't always move together. When fear dominates, monetary stress, policy uncertainty, currency weakness, investors buy physical and paper silver, pushing prices up quickly. When growth dominates, technology expansion, renewable energy build-outs, industrial cycles, silver's industrial demand lifts prices from a very real material need. This ambiguity, one market but two driving logics, creates the wild swings we see today: sharp recoveries, steep drops, sudden spikes, and persistent volatility. If silver behaved only like gold, its price action in 2026 might look calm and predictable. But being tethered to industrial demand shifts and monetary psychology forces price discovery to react on multiple fronts. That's why sometimes silver lags gold on fear-driven rallies, and other times it outperforms gold on growth-driven upticks. In simple terms, silver is not just one thing, it's multiple assets stitched into a single ticker. And that's why traders say silver can be the most misunderstood metal in financial markets. Let's look at the data. 2025 saw silver's price more than double in value, fueled by explosive industrial usage and renewed investment interest. Supply deficits for a sixth consecutive year are forecast in 2026, meaning structural imbalances are expected to persist. Industrial demand categories, from solar photovoltaics to advanced electronics, now consume a high percentage of total silver production. Investment demand remains strong as macro uncertainty makes silver a viable inflation and risk hedge. Next, consider how silver reacts compared to gold in real time. When safe haven demand emerges, gold typically moves in concert with macro tension. Silver may follow, but its industrial weighting means the metal sometimes lags behind or behaves erratically because industrial buyers don't react to fear the same way. That leads to mixed signals in price action, a hallmark of assets with dual demand drivers. And it's not just theory. Major institutions like JP Morgan see silver's price in 2026 averaging significantly higher than historical troughs, reflecting both monetary and industrial drivers. Now let's zoom out and look at the structural picture. Economies around the world are pivoting toward technology, renewable energy, and electrification. These sectors don't just use silver, they depend on it. Solar panels, for instance, require silver for their electrical contacts. Electric vehicles rely on silver in multiple subsystems. 5G and data centers embed silver in connectors and circuitry. This is not temporary. These trends carry multi-decade horizons. Meanwhile, investors increasingly see silver not just as an industrial input, but as a hedge against monetary instability and currency debasement in a world of rising debt and policy uncertainty. That dual identity, industrial powerhouse plus monetary defender, is the core of silver's current crisis and also its opportunity. Looking back historically, silver once was monetary money. Under bimetallism in the 19th century, silver circulated alongside gold and was essential to currency systems in Europe and America. But as economies centralized currency control and moved toward pure gold or fiat standards in the 20th century, silver's monetary identity faded. For decades, it became primarily an industrial byproduct, ironically tethered to the fortunes of base metal mining. Now, for the first time in generations, silver is re-emerging in both roles simultaneously, creating a rare cross-regime market environment. What does that mean for the future? Silver stands at a crossroads, a metal with multiple pricing logics that can't be ignored. The traditional gold ratio frameworks, simple fear hedge theories, or seasonal commodity cycles aren't enough anymore. Instead, you need a multi-factor perspective that accounts for industrial demand trends, macro risk and monetary policy, supply deficits and physical scarcity, investment positioning and technical breakouts. The result, silver may oscillate wildly in the short term, but structurally it remains supported by both consumption needs and monetary psychology. Forecasts suggest that if supply cannot catch up and industrial demand continues to expand, silver could break into triple-digit price territory in 2026. But this structural thesis comes with a warning. Silver's dual identity is a double-edged sword. If global growth slows dramatically, industrial demand erodes and investor sentiment shifts, silver may fall harder than gold because its industrial floor vanishes. If monetary panic rises without industrial consumption support, silver may lag gold because investors will choose gold as the pure safe haven. In other words, silver responds to conflicting signals, and that makes it one of the most sensitive barometers of market psychology and real economy fundamentals. So here's the insight most investors miss. Silver isn't confused, markets are. And that's exactly why its price behaves the way it does. Not like a pure commodity, not like a pure monetary metal, but as a hybrid asset trapped between two powerful narratives. As we move deeper into 2026, one thing is clear. Understanding silver's identity crisis isn't just useful. It's essential for anyone watching commodities, macro markets, and long-term asset flows, because the future of this metal isn't written by fear alone, or by industrial demand alone, but by the tension between the two.